If you own a condo or a townhouse in Santa Clarita area or the greater Los Angeles area and you are thinking about selling, this video is urgent. Not important, urgent, because right now in 2026, there are perfect storm hitting California condo sellers that most agents are not even talking about. And most sellers have absolutely no idea it's coming. And that is your HOA, the association you pay dues to every single month. Maybe the very thing that kills your sale, not the market, not the price, not the buyer, your HOA. And I've seen this happen firsthand. Today, I'm going to walk you through exactly how it happens, why it's more common than ever right now, and what you need to do before you list so your HOA does not become the reason your deals falls apart. My name is Rima Rafeh with eXp Realty. I've been selling real estate across Santa Clarita Valley, Los Angeles Valley for over 2 decades, and I've closed billions of dollars in real estate in this market. Condos and townhomes are a significant part of my business, and what I'm seeing in 2026 with HOA-related transaction failures is something every condo sellers need to understand before they list. So let's start with the most important thing I need you to understand. When a buyer wants to purchase your unit using a mortgage, their lender does not just evaluate buyer and the unit. They evaluate the entire homeowner association, the financial health of the association, the reserve fund, the insurance coverage, the litigation status, the percentage of units that are owner occupied versus rented. All of it. Fannie Mae and Freddie Mac, who back the vast majority of conventional mortgages, have specific guidelines that a condo association must meet before they will approve a loan or any unit within it. And then when HOA does not meet those guidelines, the condo is called non-warrantable. A non-warrantable condo is one of the most conventional lenders will not touch. If your HOA has financial problem, pending litigation, insurance deficiency, or reserve fund issues, your buyer's lender may refuse to fund the loan entirely. Not because your buyer is unqualified and not because your unit has a problem, it's because of decision your HOA board made or failed to make. Most sellers do not find out until they're already in escrow with a buyer who is ready to close. By then, it's almost always too late to fix it quickly. So let me walk you through the 5 things that are triggering this problem right now in California. The first is the Senate Bill 326. And if you own a condo in this state, this is the most urgent thing happening right now. SB 326 requires all California condo associations with 3 or more units to inspect exterior elevated elements such as balconies, decks, stairways, and walkways, and identify structural issues like dry rot and waterproofing failures. The first inspection deadline was on January 1st, 2025 of last year. As of January 1st, 2026, California enacted SB 410, which added the most recent SB 326 inspections report to mandatory seller disclosure package. So now you are legally required to provide that report to your buyer, not optional, required by law. But here's the problem. A significant number of California HOAs missed the inspection deadline entirely. Others completed the inspections and found serious deficiencies they have not yet repaired. And others are in the middle of expensive remediation projects funded by special assessment that are shocking unit owners. When buyer's lender review the HOA documents and sees that SB 326 inspection was not completed or that it revealed deficiencies that remain unaddressed, that lender may decline to approve the loan. California HOAs that missed the deadline are now facing lender refusal to underwrite loans on units within these complexes. And the seller of an individual unit has almost no power to fix that problem on their own. The second is the reserve fund crisis. California law requires HOA to reserve funds to be sufficient to cover the projected cost of repairing and replacing common area components over time. Fannie Mae and Freddie Mac are now actively scrutinizing HOA reserve fund adequacy as part of their condo approval process. A reserve fund that falls below their adequacy thresholds can result in the entire complex being flagged as non-warrantable. When that happens, conventional financing is no longer available for units within that complex. Buyers must either pay cash, find portfolio lender at significantly higher interest rate, or walk away. Your buyer pool shrinks dramatically, and so does your sale price. The third is HOA litigation. If your association is currently involved in a lawsuit, whether it's suing a developer over construction defects, being sued by a unit owner, or involved in any active legal action, California Civil Code Section 4525 requires you to disclose that litigation to your buyer. And when a buyer's lender finds out about active litigation in an HOA, many will not approve the loan until that litigation is resolved. Construction defect litigation is particularly common in newer California condo complexes and can tie up a transaction for months. And the fourth is the insurance crisis. HOA master insurance policies cover the common areas, the building exterior, the roof, the shared amenities. Those policies have become dramatically more expensive, or in some cases impossible to renew. As the carriers have pulled back from California following wildfire losses, HOA fees across California has surged as association absorbs skyrocket insurance premium. In some markets, fees have increased 60% or more in short period. When the master insurance policy has coverage gaps or deductibles that exceed Fannie Mae and Freddie Mac thresholds, the loan gets declined. NAR, the National Association of Realtors, flagged this exact problem in 2025 after members reported the HOA insurance documentation issues were derailing condo transactions, sometimes within days of a scheduled closing. And the fifth is the CCNR's violation on your individual unit. Unauthorized modification, unimproved improvement, short-term rental activity in a complex that prohibit it. All of these can create open violations on your HOA account. An HOA lien from unpaid fine or assessment attaches to your unit and blocks the closing until it is paid. A buyer who discovers open violation mid-escrow has ground to negotiate or even cancel. And most sellers have no ideas these violations exist until the title report surfaces them. Now, let me give you the practical steps to protect yourself before you list. The first step, to request the full HOA document package now, before you go to the market. As a unit owner, you have the right to request HOA financial records, meeting minutes, reserve fund studies, insurance information, and the SB 326 inspection report. Request them, review them, have your agent go through them with you. You want to know before your buyer does whether there is pending litigation, a looming special assessment, a reserve fund deficit, or SB 326 compliance issue in your complex. The second step is to check your own account with the HOA. Are your dues current? Are there any open violations or fines against your unit? Are there any liens recorded against your property? All of these must be resolved before closing. Address them now rather than scrambling mid-escrow. The third step is to check the warrantability status of your complex. Your agent or a knowledgeable lender can check whether your complex is on a Fannie Mae or Freddie Mac approved list. If the complex has known warrantability issues, you need to know that before you go to market, because it directly affects your buyer pool and your pricing strategy. The fourth step is to understand the special assessment landscape. Is a special assessment currently active? Is one being discussed? The board meeting minutes you request will tell you. Pending or anticipated special assessment, must be disclosed to the buyers. And depending on the size, they can be significantly affect how lenders evaluate the purchase. And the fifth step, and this is one that separates sellers who close smoothly from the ones who do not, is to price your unit with full awareness of the HOA landscape. A complex with warrantability issues, elevated dues, pending assessment, or SB 326 remediation in process attracts a narrower buyer pool. An experienced agent who understands that will price your unit in a way that reflects the full picture, not in a way that generates strong initial interest followed by string of failed escrow when lenders start declining loans. And here's the bottom line. The HOA landscape in California in 2026 is more complex, more regulated, and more scrutinized by lenders than it has never been. SB 326 and SB 410, the insurance crisis, rising dues, and reserve fund deficits are warrantability concerns are creating a transaction environment where the health of your HOA matters as much as the condition of your individual unit. The seller who understands this going in, who do their homework before they list, and who price with awareness of the HOA landscape, and who work with an agent who knows how to navigate these issues are the ones who close successfully. The sellers who go to the market without this awareness are the ones whose deals collapse in escrow over problems that they were sitting in the HOA documents the whole time. You do not have to be one of those sellers. If you own a condo or a townhouse in the Santa Clara Valley, Los Angeles area, and you're thinking about selling, I would love to talk to you before you list. We'll pull the HOA documents together, check the warrantability status of your complex, review your account for any open items, and build a pricing and marketing strategy that accounts for the full picture of your HOA situation, so there is no surprises when a buyer's lender start asking questions. The conversation is free and will give you more clarity than most sellers get before they're already in escrow dealing with problems that nobody warned them about. You can reach me at 661-236-8899. This is Rima Rafeh with the Rafeh Group. And if you like this video, please like, subscribe, and share, and we'll see you on the next one.